Hi, class. Welcome to week 3. Yay! So, what do we have due this week? Well, we need to read chapters 5 and 6. Hopefully, everyone's already gotten started. We need to complete homework 3. In addition, we need to participate in the class discussion. Please post at least one response by Thursday and an additional 2 responses by Saturday. This week, I've kind of decided to just go through a couple demonstration problems for chapter 5, so let's get to it. So in this example, it has the following items that we're going to actually just do the journal entries for. So let's kind of go through each one really quick. So January 2nd, we purchased inventory of 12,000 on account. On account means we didn't pay for it in cash, right? When you do anything on account, that means that's some kind of payable. From Yield Company Limited, it's a chemical importer. The terms were 210. What does that 210 means? It means that if you pay within 10 days, you get a 2% discount. Yay! N45 means that, if you didn't pay within 10 days, well, you need to at least pay that $12,000 balance within 45 days. FOB shipping point. What does FOB shipping point mean? There's FOB shipping point and there's FOB destination. FOB shipping point means like as soon as you put that inventory on that freight truck, whatever is carrying it, that belongs to you, the person that's purchasing it. And normally when that happens, you pay their freight charges and you pay the freight charges. When it's FOB destination, that means the inventory does not belong to you until it actually reaches its destination. So whatever plant that you own, whenever it reaches that destination, it becomes yours. And normally you don't pay any freight charges in that case. The person that's actually shipping it will pay the freight charges. So two, we paid the freight charges for $900. January 10th, we returned 1,200 of inventory to Yield Chemicals. January 18, we actually paid them less the return. January 20th, we purchased inventory from a different company, Taylor Chemicals now, for $8,000, and their terms are a little bit different. If you pay within 10 days, you actually get a 3% discount, which is even better than the 2 that they were given from Yield Chemical. And then if not in 10 days, you have to pay the net by the end of the month, and this one is FOB destination, so you're probably not going to have a freight charge. We received a $500 allowance from Taylor for damaged but usable goods. So they're giving us an allowance because some of the goods weren't too good. So that's $500 less that we have to pay. And then we actually paid Taylor Chemicals less the allowance and discount on January 24th. So we're going to go through each journal entry. So kind of discussed on the page before. We 12,000 on account. We're going to debit inventory for 12,000. We have accounts payable for 12,000. We paid the shipping company that shipped it $900 because it was up upon the shipping point. It belonged to us, so we paid the $900 freight charges. So that whenever we pay those kind of charges, that increases the cost of our inventory. So that's why we're debiting inventory for $900 and we're crediting it, and we're crediting cash because we paid cash. So we returned 1,200 of inventory to Yield Chemicals. So our accounts payable is gonna decrease by 1,200. That's why we're debiting it by 1,200. And our merchandise inventory is gonna decrease also by 1,200 because we no longer have that inventory because we gave it back to Yield Chemicals. January 18th, we paid Yield Chemicals for their inventory. The accounts payable, we know it's a 12,000, which was the additional costs, minus the 1,200 that we returned. So that's why we're only paying the 10,800. And also, we didn't get any discount, right? Because we did not pay it within 10 days. So January 20th, we purchased 8,000 of inventory from this different shipping company. So Merchandise inventory 8,000, accounts payable 8,000. We received that $500 allowance. So because we got allowance, our accounts payable is going to decrease. That's why we're debiting it by 500, and our merchandise inventory is going to decrease by 500 because it's not going to cost as much to us because we got that allowance for 500. January 24th, we paid Taylor Chemicals, and guess what? We paid it within the 10 days, so we got our 3% discount. So we know accounts payable is going to be 8,000 minus 500. 500 was the allowance for 7,500. Our merchandise inventory is actually going to decrease for the 225 because we didn't have to pay that 225. So because we didn't have to pay for it and we got a discount, it actually decreases the cost of the inventory. So that's why inventory is going to go down by 225. And then cash, all we paid out in cash, instead of paying 7,500, we've paid 7,275 because of the allowance that we got. Now this is another demonstration problem. It's kind of helping us to go through what is the top part of a multi-step income statement. So I kind of want to go through what is the top part of a multi-step income statement. So we start off with sales, 90,000. We have sales returns and allowances. So we've all gone to the store or we got something, we didn't like it, so we returned it, right? So that's the 900. So that's going to take away from our sales. There were also discounts. I'm sure everyone here loves discounts. So that's also going to reduce the sale by 500. So you have to say 90,000 minus 900 minus 500 gives us the 88,600. That's what we call our net sales. Very important number. Next greatest important number is the cost of goods sold. So what is the cost of the inventory that we sold? They're saying here that cost is $60,000. So we sold net sales 88,600. The cost of that inventory that we sold was 60,000. So we have a gross profit of 28,600, right? So they did 88,600 minus the 60,000. For all of these, you're basically just going to like B, C, D, E, F, and G. You're just backing into the equation I went through in the first one. So we'll slowly just show the answers for these. All right, so we're basically just going to use this adjusted trial balance to do the next set of questions. We know that this trial balance is adjusted. It's not unadjusted, so we don't really have to do anything to it to adjust it, but we're going to use this trial balance in the next set of questions. So this is kind of what we're going to do. We're going to journalize the required closing entries. Remember the closing entries that we did in the last class? We're basically closing out net income to the retained earnings. So 2, we're going to set up T accounts for income summary, retained earnings, and dividends, post the closing entries to the T accounts, and calculate their ending balance. We're going to say how much was leading's net income or net loss, and we're going to prepare a single step income statement. Single step income statement just basically mean your revenue minus all your expenses, and that's it. And the multi-step, we kind of talked about it on the previous slide, where you're doing like, your sales, less allowances, less discounts, gives you your net sales minus your cost of goods sold, gives you your gross profit. So it starts off with that. So that's kind of a multi-step income statement. So let's start with the closing entries. We had sales revenue. We know on the adjusted trial balance, we had sales revenue credit of 300, right? So we see that credit 300,000 there. To close it out, closing it out just means make it zero. We have to debit sales revenue now for 300,000 and credit income summary. And you can see the T account, it has now a credit balance of 300,000. Now we're crediting all of our expenses. So we know all our expenses on the adjusted trial balance, they were all debit. So if we go back a couple slides, you can see all of those were all debit entries. So we know we have to credit them all to zero out the expenses. And then the opposite would be income summary 236,100 a debit. So when you look at the T account, you have the 236,100 as a debit, the 300,000 as a credit. So now we have a credit balance of 63,900. Everyone knows that 63,900 is what? Our net income. So now we actually have to close out the income summary. We want that income summary balance to be zero, and we close out that income summary balance to retained earnings. So our retained earnings now is going to increase by that 63,900. So you can kind of see on the T account, you see the income summary is zero because now we've actually now closed out the income summary, and you can see that credit 63,900. So we had 20,000. Now it's going to be more a beginning retained earnings of 20,000, and then we're going to add 63,900 for the net income for this period. We also paid out dividends. Dividends are going to reduce our retained earnings, right? Because we're actually giving that earnings back to the people that own the company. So our retained earnings is going to decrease by 55,000. That's why we're debiting it. And our dividends is a credit of 55,000. As we went through all of that, we realized that our net income was, as we said before, the 63,900. This is your single step income statement. So as I said before, it's literally just the listing of your revenues and your expenses. And we know the net income, once again, it would be 63,900. This is the multi-step income statement. So we know it's the sales revenue less the returns, less the discounts, gives you net sales, net revenue, 294,500. Cost of goods sold, so the cost of the inventory you sold, 180,000. This gives us our gross profit. Multi-step income statement, you know, you always want to see like a sales, a cost of goods sold, a gross profit. Then you're going to say, what are your operating expenses? You're going to get operating income. You're going to have other revenue expenses, which normally the only thing that really falls in that is interest expense for the most part. And then, yeah, you still get to the same 63,900 as net income. Hopefully you guys enjoyed this presentation, and good luck this week. Keep up the excellent work.